Hello friend, welcome back to our new video. Today our topic life insurance. Life insurance basis. Many financial experts consider life insurance is to be cornerstone of sound financial planning. It can be important tool in the following situation. Number 1, replace income for dependents. If people depend on an individual income, life insurance can replace that income if the person dies. The most common example of this is parents with young children. Insurance to replace income can be especially useful if the government or employer sponsored benefits for the surviving spouse or domestic partner will be reduced after he or she dies. Number 2, pay final expenses. Life insurance can pay funerals and burials costs, probate and other estate administration costs, debits, and medical expenses not covered by health insurance. Number 3, create an inheritance of heirs. Even those with no other assets to pass on can create an inheritance by buying a life insurance policy and naming their heirs as beneficiaries. Number 4, pay federal death taxes and state death taxes. Life insurance benefits can pay for the state tax so that heirs will not have to liquidate other assets to take a smaller inheritance. Change in the federal death tax rules through the January 1, 2011 will likely lessen to the impact of the tax on the some people. But some states are offsetting those federal decrees with increase in their state level state taxes. Number 5. Make significant charitable contribution. By making a charity help beneficiary of their life insurance policies, individuals can make a much larger contribution than if they donated the cash equipment of the policy premiums. Number 6. Some type of life insurance create a cash value that, if not paid out of the death benefit, can be borrowed or withdrawn on the owner request. Since most people make paying their life insurance policy premium a higher priority, buying in a cash value type policy can create a kind of forced saving plan. Furthermore, in the interest created a tax deferred and taxed except if the money is paid as a death claim. Types of life insurance. There are major two types of life insurance, terms and whole life. Number 1, term life. Term insurance is the simplest form of life insurance. It pays only if death occurs during the term of policy, which is usually from 1 to 30 years. Most term policies have no other benefits provisions. There are two basic types of term life insurance policy: level term and decreasing term. Level term means that the death of benefit stays the same throughout the duration of the policy. Decreasing term means the benefit drops, usually in 1 year increment, over the course of the policy term. Number 2, whole life, permanent life. Whole life or permanent insurance pays death benefits whenever the policyholder dies. There are three major types of whole or permanent life insurance. Traditional whole life, universal life, and various variable universal life, and there are the variations within each type. In the case of traditional whole life, both have the death benefits and the premiums designed to stay in the same level throughout the life of the policy. The cost per $1,000 or benefit increase as the insured person age, and it obviously gets very high when the insured live to 80 and beyond. The insurance company play keep the premiums level with charging premium that in the early year is higher than that is needed to pay claims, investing that money and using it to supplement the level premiums to help pay the cost of life insurance for older people. By law, when these overpayment reach a certain amount, they must be available to the policyholder as a cash value if he or she die decades not to continue with the original plan. The cash value is an alternative, not additional benefits under the policy. In the 1970 and 1980, life insurance company introduced two variants on the traditional whole life product: universal life insurance and variable universal life insurance. Some variants of whole life permanent life insurance are discussed below. Number one, universal life. Universal life, also known as adjustable life, allows more flexibility than the traditional whole life policies. The saving vehicles called a cash value amounts their rate earns a money market rate of interest after money has accumulated in the account. The policyholder will have the option of alternating premium payment providing there is enough money in the account to cover the cost. Variable life. Variable life policy combines death protection with a saving account that can be invested in stocks, bonds, and money market mutual funds. The value of the policy may grow more quickly but involves more risk. In investment do not perform well, the cost, value, and death benefits may decrease. Some policies, however, guarantee that the death benefits will not fall below a minimum level. Number three and last, variable universal life. This type of policy company that features of variables and universal life policies, including the investment risk and rewards characteristics of variable life insurance and the ability to adjust premiums and the death benefits. That is characteristics of universal life insurance. Thanks for watching complete this video and don't forget our channel subscriptions and press on bell icon. So we will meet in the next video. Goodbye.